Hey, this is Matt from Health, and we're back here with episode 4 of our M&A 101 series. Today we're talking about some of the language describing the types of deals that you see. And I'm going to start by diving right in with how the deals happen. And I think the most common is a stock sale or an equity sale. If you're a business owner, your company might be a C Corp. You maybe issued 10 million shares when you started the company. Maybe you haven't done any transactions since. You're still the sole owner of the business. You own all 10 million of those shares. You decide you're going to sell the business, and when you sell, you're going to sell 10 million shares to whoever that buyer is. That's going to be a stock sale or an equity sale. Or let's say you bring on a partner, and that person might buy 3 million shares so that you have 7 million and they have 3 million. Or if you're taking on an investor, you might actually dilute by issuing some new stocks. So you'll take your 10 million shares and you'll decide, okay, snap my fingers, now we have 12 million shares. And this nice company over here decided to buy 2 million of those. So I'm not going to get into all the detail about that because this isn't about corporate structure, but those are all different sorts of stock sales. The other common type of sale is more of an asset sale. IBM used to do a bunch of x86 servers specifically that ultimately, you might remember, became Lenovo servers. So at that point, IBM Corporation had its 10 million shares, whatever it was. It wanted to sell just the server business. Well, it can't really decide, well, these million shares are the server business and these 9 million shares are the rest of the business. So what they actually did is they just sold the asset, and it worked in a similar capacity. But rather than selling the equity in particular, there were specific assets that were being sold there. So typically an asset sale is going to be something like a division, or there's some specific intellectual property, or maybe even something like real estate. There are instances of asset sales where a company might own the building they're operating in, but decide that they'd rather be leasing. They might sell that business to a company that focuses on commercial real estate and then just have an agreement as part of that they're just leasing it back. So that'd be a case where it's an asset sale. It's not part of their normal business. That company that's leasing back that building isn't a commercial real estate business themselves. They're making widgets. But in this case, they're selling that asset as a way to get a cash infusion. So then next I want to talk about the what, I guess, the what type of deals you're actually seeing and hearing about. And I think one common one is going to be something like a merger. And given this caveat 20 times already, we're not going to get into all the different complexity. There's a lot of different sorts of mergers. The one that always sticks in my mind is I remember when I was young, there was a gas company, an oil company called Exxon, and there was a gas station chain called Mobil. I think they were also drilling for gas. They merged. And so now you always hear about ExxonMobil. That's a merge. When the merge happens, it can be that two companies just traded stock. It could be that one company paid cash to buy stock of the other one. A lot of different flavors of how that could happen. And then there's even flavors where they're not exactly mergers. You could have a joint venture where Exxon and Mobil both decided that they want to start a new business together. And so they both throw in a little bit of money to start this entirely new business. Or you could have something like a consolidation where two businesses decide that they're going to come together and poof, be a whole new business. So a merger can take a lot of different forms, but ultimately, it's just two businesses that are coming together on some relatively equal footing. Conversely, there's an acquisition. And I say conversely because instead of equal footing, an acquisition is typically when one business is just buying another. And it doesn't have to be buying it in full. It could be they're buying, 40%, 80%, 99%, whatever it is. But essentially one company becomes the owner of the other company. It was probably about a decade ago that Facebook purchased WhatsApp. I think it was more recently, or was it before that they purchased Instagram? So those are instances where they're now all under the Meta umbrella once Facebook rebranded there. But that was an instance of Facebook acquiring these other companies. Similar, going back even further, once upon a time, YouTube was its own company, and then Google acquired YouTube. YouTube still operates as its own business, but it is wholly owned by Google. There's also instances of acquiring assets. Similarly, with the examples that I mentioned earlier, it could be that a division is being sold, like IBM servers becoming Lenovo's server division. Or it could be something where a company goes into bankruptcy and then all their assets are liquidated. And that could be a way to make an acquisition just of assets rather than the actual equity. One other interesting one is a tender offer. So a tender is generally a stock acquisition, a stock purchase, but it's not necessarily one that's negotiated in the same way. So a tender offer is going to be when, let's say there's a publicly traded company, there's Google, and I'm suddenly the richest man in the world. I have trillions of dollars. I decide that I want to buy Google. Well, there's a lot of people out there that own Google shares. I'm not going to call each of them up and say, hey, can I buy your stock? I could start going into, my E-Trade account that has my $1 trillion cash sitting in there and start just telling it, buy as many Google shares as that'll drive the price up. They'll see the demand. That'll impact the market. What I could do instead is say, okay, Google is, hang on, I gotta Google this to see what the Google stock price is. Google stock is currently $186. I might say, gosh, I'm confident this company's worth more. I want to buy as much of it as possible. I want to be the majority shareholder so I can call the shots, because if I can fix their AI strategy, then those Google shares are going to be worth $250 easily. So I essentially announced to the market that I am buying every available Google share for $200. That's a tender offer. I think the probably best known instance of this owns lots of breweries, lots of domestic alcohol companies. It's actually owned by, I think it's a Dutch company called InBev. And InBev acquired Anheuser-Busch by doing exactly this. They made a tender offer and bought a majority stake in Anheuser-Busch. I think they may have ultimately bought it out entirely. And then, interestingly, I used the term buyout. That's another fraught term. It can mean a lot of different things. Obviously, if you're buying all of something, that is just a pretty traditional definition of a buyout. But there's a couple slightly different definitions that are used, and there's two that I'm going to mention today. First is a leveraged buyout. Leverage, in the case of M&A and investments, whatever it is, generally means you're using debt. You have $1, but you want to pay $10 for something, you're taking out a loan. There's a little bit more nuance to that, but that's ultimately what it is. It's a way to just, you're bringing on a partner, you're taking out a loan, whatever it is, in order to make that acquisition. And so you're buying out a business with that debt using leverage to do so. Another example, and there's a little bit of overlap here, is a management buyout. Management buyout is an instance of the employees of a business going and buying that business. When I was growing up, my neighbor was a butcher. His name was Tibor. I think he was Hungarian, really nice guy. Tibor worked at the butcher shop for a long time, and then the old man who owned the butcher shop decided that he wanted to retire. So there was this business in place. I forget what it was called before it became Tibor's. They could have just gone through a rebranding process. They could have just changed the sign on the front of the building and kept all of the paperwork, all their tax filings exactly the same. But what I believe they actually did was a management buyout. Tibor was the store manager. He essentially bought all of the shares of the business from I really can't remember the guy's name, from the guy before him who owned the butcher shop. Another more public example, Dell used to be a publicly traded business 15, 20 years ago. It was originally started by Michael Dell in the 80s or 90s, became incredibly successful, IPO'd, we'll talk about that later, became incredibly valuable. Michael Dell made his billions of dollars, and he decided, you know what? The guys who are running Dell in my absence, that company still has my name on it. They're not doing a great job. I'm going to take this over and show them how to do it. So Michael Dell brought in an investment partner and he bought it out. Not every investment like that is going to be a management buyout. In that case, Michael Dell, I think, was still the chairman of the board. I don't know that he was still technically an employee at that time, but he was somewhere in that management executive level. But there are times where there can be a buyout that's not a management buyout, a company that's public going private. And an example of that is going to be Elon Musk when he bought Twitter. He also brought in some investment partners. He took on some debt, so there was some leverage there, but he took Twitter private just by buying it out entirely as a independent third party making that acquisition. So those are the different types of business deals, again, at a high level that you might see or hear about. Recapping: merge, businesses coming together; acquisition, one buying another; tender is acquisition of a flavor, and then all the various sorts of buyouts are also typically of a certain flavor. So that's it for episode 4 of M&A 101. Next time we're going to talk about how a deal works. If it's you trying to sell your business, what that process is going to look like. So stay tuned and we'll see you there. Thanks.